Three stock lunch, and we're taking a look at some huge moves off of earnings. First up, Microsoft on pace for its worst day in more than 2 years, despite an earnings beat on its cloud strength. Shares are sliding after the company's guidance for revenue growth fell short of expectations, and there were some real concerns about its spending. Here with our trades is Aadil Zaman, partner at the Wall Street Alliance Group. Aadil, what do you think of Microsoft?
Great to be with you. So I think that, generally we feel that the bar is set so high for these big tech companies, given the monster rally that they've had, that anything short of a wow earnings report is going to be met with a sell-off. And this is what we saw with Microsoft. I think one of the concerns has been that they're spending too much on AI. We actually view this as a positive because the AI business is on pace to clear about 10 billion annual run rate by next quarter, which will make it the company's fastest division to reach that mark. So they're doing a great job in monetizing AI. We like the company here. For us, this would be a buy.
All right, let's talk a little bit about Uber, shall we? Also under pressure today, down 11% after the company's third quarter gross bookings fell below estimates. Aadil, your thoughts on Uber, not as a product, but as a stock?
We actually think that this is a great company. We think that it's basically getting spooked out by the broad tech sector falling. But generally, we do agree with the Uber's CEO that this is a very sticky business, especially given the fact that they're having their membership program through the network. They're getting a lot of customers. And what we really like about Uber is their diversified mix of business. They're doing really well on the delivery business, especially with acquisitions like Postmates. So for us, this would be another stock that we would say buy.
All right, and lastly, we have Roblox shares surging today after strong earnings report, lifting its annual bookings forecast as in-game spending booms. Now, the stock's on pace for its best day since February 2023, but Aadil, you're pointing out that it's still down from its pandemic highs.
Yes, absolutely. I mean, this for us, we would stay away from it. We don't really like this company that much, So for us, this would be a sell. This stock used to be a pandemic era darling, but it's still down about 60%, more than 60% from its all-time high. Part of the reason is that their costs tend to be higher than other competitors because they're catering to their target audience is 13 years and younger. So they have to spend a lot more on things like cybersecurity. So we think this is a tough business. The company is still losing money. So we would stay away from this.
It's interesting that you say that, though. I've just pulled it up because my kids keep asking me for Roblox, and I keep saying no because it says right on the App Store it's for ages 12 plus. The fact that they are, and I've been petitioned by second graders to let my kids have Roblox. I think it's so interesting that the developer itself says it's not for those kids, and yet that's who they're catering to.
Yeah, I mean, that's interesting, right? And that's part of the challenge for their business model as well. And, they have to spend a lot of money on building out their digital infrastructure. Their costs go high as well. So I think they're just better places in the market to be right now because there's so many other opportunities.